Thank you for taking part in our quiz. So, here are the answers. For question 1, the answer is A. A crack is the colloquial term given to the cracking margin for refiners, otherwise known as the refinery margin. Simply put, it is the finished product price the refiner delivers to market less the value of the crude oil it puts in as its feedstock. There are of course many other factors, such as freight and operational costs, but this simple metric provides a gross level of profitability either for the entire refinery margin or by product. Refiners' behaviour will vary depending on the forward economics they're in the oil swaps market. For example, a low diesel crack next quarter may incentivise low overall run rates or a switch to a different grade of crude that doesn't yield as high a quantity of diesel in that time. This change in behaviour can have knock-on effects to the supply of other products and on different grades of crude oil. The crack value for product markets is therefore seen as the most important indicator of product market health and future refinery behaviour, and consequently key for speculative traders looking to predict future market price action or for refinery hedgers looking to lock in their economics ahead of time. It is also worth noting that traders prefer looking at these crack values over the outright prices of products, as there is a strong correlation with these and crude oil futures. And for question 2, the answer is C. The term value has many connotations, but when it comes to trading in oil swaps, the term is used to understand where the fair market price is for a given contract, which is usually, but not always, the midpoint between the current buying price and selling price. As oil swaps are OTC traded, or in other words traded from person to person via an electronic platform or broker, knowing where the market price is at any given time is not always that straightforward. It is highly common to begin a negotiation for a contract asking a broker where they see value before deciding where to bid or where to offer to market. And finally, question 3, the answer is B. Liquidity is the term used when assessing how close to fair market price or value a trader can execute their order. It is all well and good having an idea where fair market price should be, but if no one is willing to buy or sell close to that number in a volume that accommodates a trader's order, you won't be able to trade very efficiently. When a market is described as liquid, this means that the buy and sell orders are close to market value and in reasonable volumes, whereas a market is said to be illiquid if the executable prices are scarce and for unreliable volumes. This is where the crux of the inefficiencies exist in the oil swaps market and where market makers like Onyx come in. So, did you get all 3 right? Let me know in the comments below. Meanwhile, stay tuned, keep following, and see you next week.